Okay, just listen for a second, because something just broke in silver that you don't see very often. In less than a week, roughly 37% of silver's Western price just vanished. We're talking about a collapse from around $121 an ounce down to roughly 85, and at the exact same time, Shanghai barely blinked, holding near 122. That's not a normal divergence. That's a 40+% physical premium, and both Western futures desks and Asian physical traders are seeing it right now. Stay with me because I'm going to show you why this wasn't a demand crash, why next week actually matters more than last week, and how you can spot this setup the next time it happens. If you're holding silver right now, if you're watching this market, if you're trying to understand what just happened, your job is to understand the mechanics before you make your next move. And I'm going to walk you through exactly what those mechanics are. Before I explain what caused this, let me teach you something most people never really internalize about silver. Silver isn't just a metal, it's a leverage instrument wearing a metal costume. When it runs harder than gold. When it breaks faster than almost anything else. Think of silver like a crowded elevator with borrowed money. As long as it's going up, everyone feels smart. The ride feels smooth. But the moment it stops rising, the weakest hands don't just leave. They're forced out. And that forced exit is the key to understanding what you just watched unfold. Here's what makes silver different from almost every other asset. It sits in this weird space between industrial commodity and monetary metal. It's too volatile to be boring, too tied to paper markets to move purely on physical dynamics. And because of that dual nature, it attracts two completely different types of capital. You've got long-term physical stackers who buy bars and coins and hold them. And you've got short-term futures traders who never touch the metal. They're just trading price movement with margin. When those two groups are moving in the same direction, silver goes parabolic. But when they disconnect, you get chaos. So what does that tell us about what we just saw? It tells us that the collapse wasn't uniform. It tells us that one group got blown out while the other group held firm. And if you understand which group got hit and why, you can start to read what happens next. If this is making sense so far, drop a comment and let me know if you've been watching this unfold in real time or if you're just catching up now, because the speed of this move caught a lot of people off guard. Now here's what you need to know about how this actually works. Western silver pricing is dominated by paper contracts, futures, leverage stacked on leverage. Most people don't realize that the marginal price you see, the number flashing on your screen, isn't set by someone buying bars. It's set by traders posting margin. When silver went parabolic and pushed above 120, margin requirements quietly rose. Volatility spiked and then price stalled. That's all it takes. When price stalls after a vertical move, margin calls don't ask politely. They liquidate. Let me walk you through the sequence step by step because this is critical. Silver goes vertical. Traders pile in late, often with leverage. They're not buying physical, they're buying contracts that control physical. Volatility jumps. Exchanges see that volatility and they hike margin requirements to protect themselves. Price stops going up. Now here's where it gets interesting. The weakest balance sheets get hit first. These are the traders who maxed out their margin, who assumed the move would keep running. Forced selling begins. That selling pushes price lower, which triggers more margin calls, which triggers more selling. It's a cascade. Not because supply suddenly appeared, not because physical buyers disappeared, but because paper claims had to be unwound fast. And here's what most people miss. This cascade doesn't care about your analysis of supply and demand fundamentals. It doesn't care about inflation or central bank policy or industrial demand. In that moment, price discovery is purely mechanical. It's about who has to exit and how fast they have to do it. The market becomes a liquidation engine, and the only question that matters is how much forced selling is left. Now let me add the second layer because this is where it gets really revealing. While Western paper markets were collapsing nearly 30%, Shanghai silver stayed above 120. Think about that for a second. If this were a true demand shock, if physical buyers were actually disappearing, Shanghai would have collapsed too. But it didn't. That divergence tells you this wasn't physical buyers walking away. It tells you paper exposure was getting blown out in the West, while physical markets in Asia held firm. And when you see a 40% premium persist instead of collapsing, that's not apathy. That's stress. That's the market screaming that two different pricing systems are briefly disconnecting. Western futures traders are liquidating contracts they never intended to take delivery on. Asian physical buyers are still willing to pay 120 plus for metal they can actually touch. That gap is information. It's telling you where the real pressure is. Here's the convergence that makes this pattern undeniable. You've got extreme volatility in the West. Check. You've got paper selling that doesn't match physical behavior. Check. You've got premiums that refuse to die even as Western prices crater. Check. When those three things line up at the same time, you're not guessing about what's happening. You're reading a fingerprint that's appeared before. But here's the part that should make you nervous. Once you're in this kind of price discovery, Headlines stop mattering. Fundamentals stop mattering in the short term. What matters is whether forced selling is finished. If it is, you get violent rebounds. If it's not, you get deeper retests that feel unfair and irrational in real time. And you won't know which scenario you're in until the market shows you. Now let me show you why this pattern matters. This is the exact same playbook we've seen before, and I want to walk you through the history so you can see the rhyme. Go back to 2008. Silver collapsed hard during the financial crisis. I mean really hard. It went from near $20 down to under $9 in a matter of months. Liquidation was brutal. Credit markets were freezing, margin calls were everywhere. And then what happened? Once liquidation cleared, once the forced selling exhausted itself, silver ripped. It didn't happen overnight, but within 2 years, it had more than quadrupled. Now look at 2011. Silver hit nearly $50 an ounce in April. Parabolic top. Everyone was euphoric. And then it got smashed. A brutal, ugly correction that felt like the end of the world if you were holding. It chopped around for months. Volatility stayed elevated. And it took years before direction really resolved. But here's the thing. The crash itself wasn't the end of the story. The behavior after the crash was what mattered. Those who understood the mechanics, who waited for stabilization, who didn't panic, they had opportunities. And then March 2020. Remember that? Silver got obliterated during the liquidity panic. Everything was selling. Stocks, bonds, gold, silver, crypto, you name it. Silver dropped from over $18 down to under $12 in a matter of weeks. It felt like capitulation. But what happened next? Within a year, silver had almost doubled. It ran back above $28. Same pattern. Forced liquidation, panic selling, then recovery once the pressure cleared. Every time this has happened, the crash itself wasn't the signal. The crash was mechanical. What mattered was what happened after. Did the market stabilize? Did physical demand hold? Did premiums persist? Those were the questions that told you whether the bottom was in or whether more pain was coming. And here's what you see when you zoom out. Silver doesn't top quietly. It doesn't bottom gently. It moves in waves of forced behavior, and those waves leave fingerprints. Extreme volatility, paper selling that disconnects from physical, premiums that refuse to collapse even when Western prices crater. When those three line up, you're not in uncharted territory. You're in a pattern that's repeated multiple times in the last 20 years. So where does that leave us now? It leaves us in a moment where pattern recognition matters more than prediction. You're watching to see if the forced selling is done. You're watching to see if Shanghai holds. You're watching to see if Western prices can stabilize, or if there's another leg down. That's the game right now. Now, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this keep falling? Absolutely. If liquidation isn't done, if there are more weak hands that haven't been flushed out yet, price doesn't care about your conviction. It doesn't care that you think $85 is cheap. It'll go to 75 or 70 or wherever it needs to go to clear the sellers. Could there be manipulation? Sure. Could there be big players intentionally slamming the market to shake out retail? Maybe. But here's the thing about blaming shadowy villains. It doesn't help you make decisions. It doesn't give you actionable information. Whether this move was organic liquidation or coordinated selling, the mechanics are the same. Price went down, volatility spiked, premiums persisted. Those are the facts you can observe and trade around. Could the fundamentals have changed? Could something have shifted in the supply and demand picture that justifies this move? Possibly. But in a week? That's unlikely. Industrial demand doesn't vanish in 7 days. Mine supply doesn't double overnight. The fundamental picture that existed at 121 probably still exists at 85. What changed wasn't the fundamentals. What changed was who was forced to sell and how fast they had to do it. Here's what I want you to focus on instead of narratives. Focus on what you can actually observe. Price levels, volatility, premiums, liquidity. If silver loses $80 cleanly and can't reclaim it, the risk shifts lower. If Shanghai collapses under 115, that changes the story. If Western premiums disappear and physical buyers step back, that tells you something different than what we're seeing now. Skepticism isn't bearish. It's disciplined. It's how you avoid getting caught in narrative traps. There are probably 3 types of people watching this right now, and I want to speak to each of you directly because your situation matters. The first type is panicking. You bought near the highs. Maybe you got in at 110 or 115. You're underwater. You feel sick every time you look at the price. And you're wondering if you should just cut your losses and walk away. That's human. I get it. Your job right now isn't to predict a bounce. Your job isn't to be a hero. Your job is to protect capital and avoid emotional decisions. If volatility is still expanding, if we're still seeing wild swings, patience is a position. You don't have to do anything. You don't have to average down. You don't have to sell at the bottom. Just wait. Let the market show you that it can stabilize before you make your next move. And if you're sitting on a loss that's too painful to hold, that's okay too. There's no shame in cutting a position that's disrupting your sleep and your mental clarity. But make that decision from a place of calm assessment, not panic. The second type is excited. You've been waiting for a smash like this. You've been sitting on cash, watching silver run, wishing you could get in at a better price. And now you want to buy everything right now. You want to back up the truck. I get it. The opportunity feels obvious. But let me be honest with you. Catching falling knives feels heroic and often ends badly. You want stabilization, not heroics. You want to see the market prove it can hold a level before you commit capital. If you're in this group, here's what I'd suggest. Scale in. Don't bet the farm at 85 if there's a real chance it goes to 70. Use this as an opportunity to build a position over time, not all at once. Set levels where you'll add if price holds and proves itself. And if it keeps falling, you'll have capital left to add lower. That's not bearish. That's smart risk management. The third type is already positioned long-term. You're not trading this. You're stacking physical. You're watching calmly because you've seen volatility before and you know it's part of the game. For you, this is about scaling, not swinging. Same rules apply. Let price prove itself before you act. If you want to add to your stack, wait for signs that the selling pressure is exhausted. Look for stabilization. Look for Shanghai holding firm. Look for Western prices finding support. No matter which group you're in, the universal principle is this. Don't trade headlines. Don't trade emotions. Trade structure. Let the market tell you what it's doing through price action, through volatility, through premiums. Those signals are more reliable than any narrative you'll read or any prediction you'll hear. So here's what I want you to answer in the comments. Which type are you? Are you holding and stressed? Are you waiting to buy? Are you already positioned long-term? Let me know where you're at because understanding your own position is half the battle. Now let me tell you where I stand personally. I'm not euphoric and I'm not panicking. I'm observant. I'm watching this unfold with the understanding that forced liquidation creates opportunities, but only if you're patient enough to wait for confirmation. First, I'm watching $80 to $85 as a near-term floor. If price can hold that zone and start building support, that tells me the selling pressure might be exhausted. If it slices through 80 cleanly and doesn't look back, that tells me there's more pain coming. Second, I'm watching 70 to 75 as a deep washout zone. If we get there, that's where things get really interesting. That's where you start hearing chatter about levels that seemed impossible a month ago. Remember when people were talking about $50 silver as a worst case if liquidation really got ugly back in the day? At 75, you're in that kind of psychological territory. Not saying we get there, but I'm watching it. Third, I'm watching Shanghai closely. As long as Shanghai stays above 115, physical demand is telling a different story than paper. That divergence is valuable information. It tells you the dislocation is real, not imagined. It tells you there's still underlying demand even if Western futures are getting hammered. If Shanghai breaks under 115 and starts tracking with Western prices, that's when I'd get more cautious about calling this purely mechanical. Fourth, I'm monitoring volatility itself. When volatility starts to compress, when the daily swings start getting smaller, that's often a sign that forced selling is winding down. We're not there yet, we're still seeing wild moves. But when that changes, it matters. Based on my analysis, this move was mechanical, not emotional. It was structural, not random. The fundamentals didn't vanish in a week. Industrial demand didn't collapse. Central banks didn't suddenly reverse course. What happened was a paper market liquidation event, and those events create noise, not signal, in the short term. The underlying drivers that took silver to 120, whether you believe in them or not, they're probably still intact. If history rhymes, and I think it does, the next phase isn't quiet. It's not a slow grind. It's volatile, it's revealing, and it's full of opportunity if you stay disciplined. These kinds of moves shake out weak hands and create setups for those who are patient. They punish panic and reward preparation. And the people who do well in these environments are the ones who can stay calm, watch the data, and act when the market gives them confirmation, rather than trying to be heroes. I'm not a financial advisor. This is not financial advice. Everything I've shared here is my analysis of what I'm seeing in the market, but you need to do your own research. You need to make your own decisions based on your own risk tolerance and your own situation. Don't take my word for anything. Verify the data yourself. Look at the charts yourself. Make your own assessment. If you made it this far, you're the kind of person who's willing to dig deeper than headlines. You're the kind of person who wants to understand mechanics, not just react to price moves. That mentality will serve you well, not just in silver, but in every market you ever trade or invest in. The ability to stay calm, think critically, and act on structure rather than emotion is worth more than any single trade. If this breakdown helped you see what's happening more clearly, do me a favor. Share this with someone else who's trying to make sense of the chaos. Hit that subscribe button if you want more analysis like this. And drop a comment letting me know what you're watching, what you're thinking, and where you think this goes next. I read every comment, and your perspectives help me sharpen my own thinking. Stay sharp out there. Think critically, verify data, and make your own decisions. I'll see you in the next one.